Welcome to The Explainer. Today, we're diving headfirst into the fascinating and honestly completely wild future of global economics. We are going to look at how the fundamental ways we measure success, define quality, and conduct business are undergoing a massive, absolutely necessary evolution. Seriously, if you think the economy is just about producing more stuff to make more money, well, this explainer is going to completely change how you see the world.
So, I want to start by throwing a pretty provocative question your way. Is our current definition of economic growth actually making us poorer? For decades, we've basically equated a healthy economy with a growing gross domestic product, or GDP. But here's the catch. GDP only measures the flow of production. It doesn't actually tell us if that production is building lasting societal wealth or if it's just draining our resources and leaving us with, well, literal mountains of waste.
To really get why this is such a huge problem, we have to look at the system we've been running on since the Industrial Revolution. It's the linear industrial economy, and it's essentially a super fast-paced, one-way conveyor belt. We extract resources, we manufacture objects, we use them for a fraction of their potential, and then we send them straight to the landfill. In this highly transactional model, success is measured purely by how much stuff we can push from the mine to the dump. Okay, let's break this down a bit more. The old system, linear growth, basically just values monetary throughput. More stuff made and sold equals a higher GDP, right? But the new paradigm, which we call performance growth, completely redefines success. In this new world, growth means increasing actual societal wealth. It's not about the sheer volume of money flowing through the register. It's about maintaining and improving the assets and physical resources we already have. And you know what else? This whole linear trap completely distorts how we think about quality. Currently, quality is just defined as the absence of manufacturing defaults, which, let's be real, is usually only guaranteed for a year or two anyway. It's judged by what goes wrong on the assembly line, not by how long a product actually serves society. Think about a toaster that mysteriously breaks the exact week after its warranty ends. That is linear quality in a nutshell, completely ignoring the crucial factor of time. Now, a super vital stepping stone away from all this waste is the circular industrial economy. This model takes that straight, wasteful line and finally bends it into loops. Instead of heading straight to a landfill, the focus shifts to the use phase of an object. We enter the eras of reuse, repair, and remanufacture, keeping those precious resources circulating. It's a hugely optimistic shift for sure, but it's really only part of the solution. But to hit the ultimate solution, we need a total mental reframe. Seriously, ask yourself this. What if we measured economic wealth like a bathtub? I know, it sounds a little strange at first, but stick with me because this is going to be our big aha moment for this explainer. Right, so imagine bathtub economics. In the old linear economy, we only measured the water flowing in from the faucet. That's our GDP. But true wealth isn't the speed of the water flowing in. It's the actual water level maintained inside the tub. That water level represents our physical stocks and assets. The performance economy focuses entirely on maintaining that stock, carefully managing the inflow of new goods and drastically minimizing the outflow of waste.
This brings us to the ultimate paradigm shift, the performance economy. In this model, companies sell objects as a service. They're selling the function while retaining ownership of the physical object itself. And because the producer keeps ownership, they naturally internalize the costs of liability and waste. Suddenly, they are highly incentivized to make things last practically forever. We stop pushing products and start actually managing wealth.
So, how does this actually work in the real world? Well, this new business reality operates across three core domains: retained ownership and liability, original equipment manufacturer or OEM skills, and operation and maintenance or O&M skills. Where these three intersect is where the absolute magic of selling performance happens. We can actually break those intersections down into four really relatable pillars. Combining ownership with operation skills gives us goods as a service. Think of catching an Uber or leasing a car. Combining ownership with manufacturer skills creates molecules as a service, like chemical leasing. Then, of course, we have the sharing economy, like Airbnb. And right in the middle, the sweet spot, we get function guarantees, where a company outright guarantees a system will work flawlessly. Because the producer now retains the product and guarantees its function, quality gets totally, radically redefined. It's no longer just, hey, did it break out of the box? Quality is now the optimization of a system over long periods of time. The longer it lasts, the more profitable it is. A pretty surprising real-world example of this? Rolls-Royce.
Faced with the reality that remanufactured jet engines were lasting longer and cutting into their new sales, they shifted their entire strategy. They moved from merely selling engines to a power-by-the-hour total care model. They literally sell guaranteed hours of turbine function. And the result? Their profits rose by 17%, with service revenues completely dominating their turnover. So, how exactly did they pull that off? Basically, by optimizing performance from space. They use in-flight satellite monitoring to track engine health in real time. If they detect even a slight anomaly, they schedule maintenance at the plane's very next destination. They even developed high-tech spareless repairs, which means they can rebuild a broken turbine blade without keeping a massive, expensive inventory of parts lying around. The really crucial takeaway here is that manufacturers are essentially becoming fleet managers. Take the Michelin fleet solution, for instance. Instead of just selling tires to lorry operators and waving goodbye, Michelin started selling miles of motoring. They manage the entire tire stock for a flat fee per kilometer driven. They operate mobile workshops, they regroove tires right where they're used, and then they retread them. It reduces fuel consumption, drastically extends the tire's service life, and completely guarantees performance. Now, I have to say, this transition is not always smooth sailing. As the source material warns, do not underestimate resistance to change and loss of market power from existing partners. Case in point, in the late 1980s, the agrochemical producer Ciba-Geigy offered a performance service in Madagascar. They guaranteed pest-free fields and higher crop yields instead of just hawking pesticides. It was a massive success. Pesticide use dropped 70% and yields shot up by 400%. But the project was ultimately abandoned because local pesticide distributors who lost their traditional sales fiercely opposed it. The old system fought back hard. But when companies actually manage to break through all that resistance, the economics are just incredible. Look at railway tracks. The traditional approach of manufacturing and selling new steel rails is a globalized, super low-margin commodity business. But alternatively, a company called Spino sells the service of perfectly ground rails. They use highly specialized trains to grind worn rails directly on the tracks, charging a pay-per-meter fee. It's a highly profitable local service that costs half as much as actually replacing the rails. And the innovation here, it can be totally spontaneous and completely out of the box. Take this Austrian dairy farmer. Facing lost milk subsidies, he used his farm's bio-waste to power a leased incinerator, creating a zero-carbon district heating network for local homes. He literally sold heat as a service. And because he laid a telecom cable alongside the steam pipes, he eventually expanded into offering remote security and internet. He went from milking cows to becoming a high-tech facility manager. How cool is that? Of course, for these incredible systems to thrive at scale, policymakers have to step up and create a level playing field. This means shifting to taxing the consumption of non-renewable resources rather than taxing human labor. It means extending depreciation periods to actually reward companies for making long-lasting goods. And most crucially, governments must create national statistics that measure actual changes in physical wealth, not just the rapid GDP throughput. Ultimately, it all comes down to this. Sustainability and the circular economy are essentially two sides of the exact same coin. In the old linear economy, the word caring is basically unknown. But in the performance economy, caring is the central objective. We absolutely must care for our natural capital, our human capital, and our manufactured physical assets. We've seen how keeping that water in the bathtub, maintaining the value, utility, and purity of our physical stocks is the true marker of a truly wealthy society. So I want to leave you with this final provocative thought. If the future of wealth is maintaining what we already have, what are you still rushing out to replace? Think about your own role in this massive paradigm shift. Thanks for joining me on The Explainer, and keep questioning the way things work.